This is how you can buy your first home this year. You gotta pay close attention to this one because if you're a first-time home buyer in this new home buying generation, you can't use the old strategies to get you into a house. And buying a house is getting more difficult each and every day. So if you don't make a plan now, you might be out of luck for a long time. Let's go. You want to ignore the noise around you and other people's opinion on what you should do and figure out if buying a house right now is the best move for you. According to the construction coverage study, out of 338 US cities analyzed, it's cheaper to buy in only 28 of those markets. So if you want to buy, you really have to know why. And there are plenty of good reasons. Maybe you want a house that you can call your own, somewhere you can update and change it into what you want it to be. And of course, housing prices will continue to rise over the long run, so locking in your monthly payment may be valuable instead of you having to deal with constant rent hikes every year. It really is a personal decision that only you and your family can make. Once you say to yourself, okay, I'm ready to buy, then you gotta figure out how much house you can afford. Take a comprehensive look at the total cost of home ownership and see how that fits into your overall financial plan. Most first-time home buyers just use whatever they're paying for rent as their monthly budget for a mortgage. But buying is riskier than renting, and there are additional expenses besides principal, interest, insurance, and taxes, which are usually rolled up in one mortgage payment. You also have expenses like HOA fees, maintenance, and repairs. Your rent payment is basically the most that you will spend on a monthly basis when you rent, but a mortgage is the least that you will pay on a monthly basis when you own a home. So you need to account for all those additional expenses and make sure you can definitely make the payment without squeezing your budget too tight. If you spend 50% of your gross income on your mortgage and other housing related costs, you most likely won't be able to save and invest 15 to 20% into retirement. You may not have room in your budget for childcare and transportation and utilities and groceries and insurance and healthcare expenses and vacation and fun date nights and being generous to other people. It's expensive out here in these streets, and you don't want to be house poor. If you're looking to buy a house, you need to sit down and do a preliminary zero-based budget to make sure your housing expenses work within your money plan. A zero-based budget is one in which your income minus all your expenses equals zero. Make sure your budget is set before moving forward, and don't let your agent or your lender convince you to go over. In 2022, because of the crazy housing market, over 60% of new home buyers spent more than 30% of their income on housing expenses. Around 6% of people spend over 50% of their income, which is crazy. Now, there are different philosophies on how much house you can afford, but in my opinion, the best rule to go by is the 25% post-tax rule. Now, the 25% rule is more of a guideline than a rule, but in my experience, it's wise to adhere to this. This rule states that you should spend no more than 25% or a fourth of your take-home pay on housing-related expenses. Now, in today's market, people usually get very upset when you mention this rule because housing is so expensive and because your lender will usually approve you for more house than this. The median household income is around $6,500 a month or about $5,000 after taxes. This means your housing budget would be a little over $1,250 a month. It's very hard to find that in this market. Even with 20% down, a $300,000 house is going to run you around $2,000 a month. But here's why the 25% rule makes sense. The average American spends 33% of their income on housing, but the average American, 78% of them actually, live paycheck to paycheck. So you don't want to be the average American. But on top of that, if you look at what most people spend money on, spending more than 25% on housing expenses won't fit the typical budget. With a typical income of $6,500 a month or $5,000 take home, you should aim to invest at least 15% of your before tax income, which is a little less than $1,000, into retirement. Most people spend about $2,000 a month on non-housing related necessities like transportation, not even including car payment, food, healthcare, and insurance. Then they spend about $700 a month on other expenses like eating out, entertainment, clothes, and charity. So that only leaves $1,300, which is very close to 25% of take-home pay. Now, of course, most people don't spend exactly those percentages, so that's why the 25% rule is a guideline, but I recommend using it. If you're absolutely against it though, at least start with 25% in your budget, then you can decide what areas you want to cut so that you can put more money towards house payments. And definitely don't go above 28% of your before tax income, which is what most lenders want to see. Even if you're able to make it work, don't buy too much house. Next is getting rid of debt. It's best that you pay down debt before buying your house for a couple reasons. First, you don't want to go into the biggest debt of your life already having a bunch of other debts hanging around your neck. Being in debt makes it more likely that you will default on your mortgage and end up losing your house. This is why lenders always look at your debt to income ratio. They typically like to see that no more than 36% of your income is going towards debt payment of any kind, because they want to make sure you can always make your mortgage payment. So the more debt you can pay down, the better. Now, it's best if you're completely out of debt before buying a house, but if you're dead set against that for whatever reason, you definitely at least need to be out of high interest debt like credit cards. And you also need an emergency fund of 3 to 6 months because things in houses break. Also, other situations come up like losing a job or having medical emergencies. You don't want to risk losing your home because you can't make the mortgage payment. You need an emergency fund before you buy a house. The next important thing is to get your credit score right. Your credit is a major factor in determining whether you get approved for a loan or not, as well as your interest rates. So it heavily impacts how much house you can get, as well as your monthly payments. Your credit score determines if you get a 6.5% or an 8% interest rate and can make a $300 to $400 difference in your mortgage payment. Your credit score ranges from $300 to $850, but you typically can't get a conventional loan if your credit score is below 620, and they really want to see you at least above 670. But even if you can get a loan below that, it's not a good idea because bad credit score means you already have too much debt and are most likely having a hard time paying it off. You don't want to buy a home in that kind of situation. The more you can improve your credit score, the better. Now, if you don't have a credit score, you can go through a process called manual underwriting to get a mortgage. It's more of a hassle because of the paperwork, but it's not that big of a deal. Once you understand your budget, it's a good idea to get pre-approved by 3 different lenders so you can know exactly how much house you can get. And then start looking for your next home. Now, this is where things might need to change from a traditional home buying experience. Most of the time, you want to find an experienced real estate agent that can help you find your dream home in the right neighborhood within the price point you want. And this is still good to do. But the housing market is very tough right now, so you might need to change your mindset and start to think like an investor. In a past life, I was a co-founder of a real estate investment company, and I would spend a lot of time analyzing properties, cold calling potential leads, or driving for dollars, which is a practice which you systematically map out every single road in your area, drive every single neighborhood and street, and find either abandoned properties or properties that look unkept. Many times owners are not able or don't have the money to upkeep the property. Maybe they're behind on payments and about to get foreclosed on, so they may be willing to sell at a significant discount if you can get them out of their situation. But in any case, that experience completely changed the way I look at properties. Now I always look at it from the eye of an investor and getting a deal, not falling in love with properties. Now, most people aren't investors, but that doesn't mean you can't look at your first home as an investment. Don't look for a dream home, look for a great deal. Even though a lot of people love the idea of a forever home, most likely you won't be in your first home that long anyway. In fact, most people assume they'll be in their homes for 15 to 20 years, but the average length of home ownership is 8 years, with almost half of homeowners staying in their home for 6 to 10 years. So remember, your first home isn't your forever home. The next tip is to stay away from hot property. If you're buying your first home, it might not be a good idea to look at hot properties. You don't want to go to Zillow or Redfin and look at the houses with spectacular photos taken with wide-angle lenses, properties that's been staged and looks like a cover of a magazine. No. You want to look at properties where the listing photos are ugly, they didn't bother to pick up their clothes in the corner of the room before taking a picture, it's been on the market for many days, or the contract has fell through a couple times. You want something that has good bones, but because of how they marketed the house, it's not appealing to people. This is how you find a good deal on a house. You can also look for a fixer-upper. Not a gut job unless you're experienced, but sometimes you can get something and fix it up over time. If you're willing to put in the time to renovate, you can end up with the property you want at a very good price. If you aren't into doing home projects or don't have the ability to renovate yourself, you'll also need to find a good contractor to do the work. For most people, finding a house with a decent curb appeal, good bones, good foundation, plumbing, electric, HVAC, good roof, but it's just dirty and outdated is the way to go. You want something that has terrible aesthetics that will turn most people away, but will be pretty easy to fix up. It's not hard to paint or put in new carpet or hardwood floors or some cabinetry. It's okay if you don't have the newest quartz countertops when you first move in. That can always be added over time as you save more money. I still like to keep up with what's going on in the local housing market, and quite often I see houses on Redfin or Zillow that have sold for very good prices. And when I look into it, it's almost always a real estate investor that bought the property and fixed it up. you can do the same thing. The next strategy you can use to get into your first home is to expand the area in which you're willing to live and look in markets that are not hot markets. Now, I understand real estate is all about location, 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 and you want to be in a safe area close to work, has all the nice restaurants and shopping and perks and good schools. But again, your first home doesn't have to be your forever home. And your particular situation might not even require you to have some of these perks. Maybe you're newly married and don't want to have kids for a few years. Well, you won't need a good school district for 7 to 8 years. Maybe you're a homebody and all you need are a couple good restaurants and a movie theater. Or maybe you have a remote job and can pretty much live anywhere you want. Whatever your situation, if you want to get into your first house, you might need to sacrifice some of the nice to haves on your list for a few years until you can move up in house. Go on Redfin or Zillow. If you don't see any properties in the price range in your area you want, zoom out a little bit until you do. Then research those areas to see if they would be acceptable. If you have an experienced agent, they would know what surrounding areas have low crime rates and would still be good fits based on your criteria. Once you find the perfect home, then you can make an offer. Your agent can help negotiate with the seller to reach a price that works for both parties. After your offer is accepted, then it's time for inspections and appraisals. These will ensure that your home is in good condition and worth the price you're paying. Please don't waive inspections just to get into your first house, because that can get you into big trouble. 14% of buyers are still doing this, but it's not a good idea. Then finally, close the deal, sign the paperwork, pay the closing costs, and get the keys to your new home. It can be an awesome experience getting into your brand new home for the first time. So don't make it a nightmare by buying too much house. You want to buy it in the right way. Now, something that can prevent you from being able to afford a home is a massive car payment, and you don't want that. So check out this video right here to see the best way to buy a car.